The conference will reconvene. I now will call up that part of Title IX, which included the Harkin Amendment, further promoting the adoption of the NAIC model regulations that enhance protections of seniors and other consumers, and all things good and wonderful. I think that was in the title. And I now recognize the Senate has sent us the Harkin Amendment, which exempts these securities, these insurance products, from being considered securities. And I now recognize the gentleman from New York, Mr. Meeks, to make a motion.
Yes, I make a motion that we concur with the Senate offer on the Harkin Amendment.
The gentleman from New York has moved that the House concur in the Harkin Amendment, which, as I just explained, says that these insurance products are not to be considered securities and will not be regulated by the SEC in a binding way. I now recognize the gentleman from New York to speak on his motion.
Thank you, Mr. Chairman. Last year, I introduced H.R. 2733, the Fixed Index Annuities and Insurance Products Classification Act, to clarify the exemption for certain annuity products from the Securities Act of 1993. Though for a while FIAs were subject only to state regulation, former SEC Chairman Chris Cox, in the midnight hours, snuck in Rule 151A during the waning hours of the Bush administration, proposing to regulate FIAs as securities. The main reason I introduced this bill in the House is because, one, it is really, a lot of it is about jobs. In today's environment, the most important thing we in the public office can do is to protect small businesses especially and create jobs. And reversing the long-standing practice of state-based regulation of fixed index annuities and classifying FIAs as securities has a direct impact, or will have a direct impact, on jobs. Adoption of Rule 151A would permit only individuals registered with the SEC as broker-dealers and their affiliated persons to sell FIAs. Thousands of solely state-licensed insurance agents would be suddenly shut out of this market, potentially ruining the many small businesses that specialize in these products and rely on independent agents to distribute them. And the big insurance companies, the big guys, will be the ones that then will move in to this industry exclusively, shutting out many of the small guys. And I believe that, number one, is bad for the local economies and the wrong message to send, especially in the time of economic turmoil. Among the many errors that I think that some of the opponents of the legislation have asserted is that fixed index annuities are hybrid products, as we heard during the Senate debate, that warrant duplicate oversight by the SEC. In actuality, legal precedent establishes that FIAs are guaranteed insurance products and are marketed as such. Thus, FIAs are not complex hybrid products. These products are aggressively regulated by the states and oversight by the SEC, which subject the industry to dual regulation by federal securities law and registration requirements, adding filing obligations and compliant costs. The SEC initially began the rulemaking process for Rule 151A under the guise that there were rampant abuses in the marketplace. Once the facts came out, however, it was clear that there were very few complaints, and complaints continued to trend downward. The SEC thus abandoned this premise and began asserting that the product was a security because it contained investment risk to consumers. However, like other fixed annuities, indexed annuities guarantee purchasers' principal and a minimum rate of interest. They cannot lose their principal. Consumers have no risk of loss or reduction of contract values, and accordingly, insurers bear the primary risk of managing their investment to support consumer contract values. None of the risk is passed through to consumers. Currently, we've had a number of members, 87 co-sponsors in the House and 15 co-sponsors in the Senate, and therefore, Mr. Chairman, I strongly would recommend that we accept the offer made by the Senate, and this is a bipartisan bill, so therefore, on behalf of myself and Rep. Baucus, I request that the House accept the Senate offer regarding index annuities.
Gentleman from Alabama.
Thank you, Mr. Chairman. I rise in support of the gentleman's, I think, very well-reasoned proposal. The SEC's Rule 151 would bring fixed indexed annuities under its jurisdiction. Currently, primary jurisdiction for regulating life insurance and annuities is vested with the states. And one thing we've witnessed over the past 2 years is the states did an excellent job of regulating the insurance industry. The Harkin Amendment would exempt fixed income annuities already regulated at the state level from additional regulation by the SEC. The SEC rule reclassifies a long-standing insurance product as a security product by not treating them as exempt securities. It would lead to other traditional insurance products being reclassified as securities, including possibly whole life insurance, which typically credit interest above a minimum guarantee. The states have, as I said, effectively regulated fixed indexed annuities, while the SEC has had their hands full with the jurisdiction they have, and we will add today. So why put something else on them when they're struggling, particularly something that the states are doing a good job with, and remove that from the states? Over 40 states have an Annuity Suitability Model Act adopted or a variation thereof. And this, the Harkin Amendment is really a strong incentive for more of them to adopt the Model Act. In conclusion, I will simply say the SEC's Rule 151A, which we attempt to strike, is unnecessary, duplicitous, and diverts the SEC's resources from other critical areas, including investor protection. So I urge all my colleagues to support the amendment.
Mr. Chairman.
Who seeks recognition? Well, I'll go to the Democratic side to speak in opposition to the amendment. I have generally been supportive of the Authority of Insurance Commissioners. I would note that this does not, the current situation that we have wouldn't displace the insurance commissioners, but it would make it a dual responsibility. I would note from the standpoint of states versus federal, this is a somewhat mixed picture, because I have a letter from the North American Securities Administrators Association Incorporated, signed by the Chief Executive Officer, Sir Kevin Keller, opposing the amendment. That is the Securities Administrator. So the point is that this is not simply state versus federal. It is whether these are insurance products or investment products. And that's why the state securities administrators differ with their state insurance commissioner friends, because it's as much, if not more, a definition as to whether or not these are securities. I know that the Consumer Federation also considers them to be securities. I did talk to the Secretary of the Commonwealth of Massachusetts, who's opposed to this, who has some enforcement actions he thinks might be jeopardized by it. So I believe the dual responsibility is a better way to go, and I am opposed to the amendment. The gentleman from New Jersey.
I thank the chair, and I thank the gentleman for his amendment, and I speak in support of the amendment, having already been a co-sponsor of the original legislation, and commend the gentleman who's not with us today, the other co-prime sponsor of the bill, who also serves in this committee, Mr. Price of Georgia, for working across the aisle and for the underlying legislation. You know, very briefly, the fixed index annuities that we're talking about here, they're not new. And they've always been treated and regulated as insurance product. And I can see that one might oppose the amendment, the gentleman's good amendment, if there was evidence of problems in this area. But no one has lost a penny on account value due to the crisis we're in or the stock market volatility in the area. And the record shows that states have effectively, basically regulated this product over time. Over 40 states have an annuity suitability model has adopted or variation thereof. So we have seen the appropriate regulation going on. And the other factor about this is that, well, first, as the ranking member has indicated, the SEC already has, as you said, a lot on their plate. Why are we thinking that we need to add one more thing to divert their attention from their primary function? And secondly, even if you think that they can handle one more thing with or without the extra pay salaries we're going to be giving those folks over there in this bill, you have to realize that this approach, absent this amendment, will not add 1 degree of extra protection in reality to the situation. The difference between the SEC approach and the Harkin approach is not the standard that's going to be applied. It's basically who the regulator is going to be and who can sell the product. So on the latter point of who can sell the product, you can very well imagine there's just jurisdictional aspects as people who want to retain the jurisdiction of whether they can sell it or someone else can sell it. But more importantly, to who should be the regulator, as again, under the amendment, state insurance regulators will still be required, as they are now, to hold insurance agents to the same high standard of behavior as the SEC is seeking to hold broker-dealers to. That means we're not going to get a higher bar or a higher level of protection just because the SEC is now involved. It's the same bar, and the regulators are going to be doing the same great job they have in the past. In addition, the amendment means that state insurance commissioners can hold insurance companies responsible for the behavior of those who sell the annuities. Well, that's something that the SEC can only hold the broker-dealers to that standard. So I think it's beneficial to move this amendment, and I can again conclude by saying the gentleman has approach.
Mr. Chairman. I'm sorry, the gentleman from Iowa.
Well, thank you very much. I appreciate this being before us, and I have to concur with what was just said. I've talked with a number of entities in my state when the turn has caused me to talk to others across the country, and it is an insurance product. I agree with what's been said in many respects, and of course the SEC would, because of what's been going on, would make the move they have, but I don't think it's necessary. The insurance commissioners are on top of it in 37, now you tell me 40 states, and I would guess that very soon the rest of them will join. And they can do it at that level. It's working very good. The users of it like it, and it's safe. And so I had many things I was going to say, but a lot of it's been said, so I'll not repeat it. Just say that I do support the Harkin Amendment and would hope that it would pass. Thank you. I yield.
I just asked him to correct I held two pieces of paper together. So I want to make the point that Kevin Keller is not the executive director of the North American Securities Administrators Association. He's, in fact, the executive director of the association on whose behalf he did write, which is the Certified Financial Planner Board of Standards. They were also opposed to this, but Mr. Keller, and I'll put these in the record, is the executive director. The letter from the Securities Administrators is signed by a frequent witness, the long-standing, appointed by both governors of both parties, Denise Voigt Crawford, who is the Texas Securities Commissioner. Are we ready to vote on this question?
Can I ask a question?
Already spoke of more letters, yeah.
Yeah, I would just like to introduce the letter from the National Association of Insurance Commissioners.
All right. Without objection.
Mr. Chairman.
Gentleman, North Carolina.
Move strike last word. Just to ask a question of whoever can answer it. I'm looking at the Harkin Amendment, and it seems to me that starting on June 16, 2013, if states have met certain criteria, then this doesn't seem to be any duplication. I'm trying to figure out what will happen between now and June 16, 2013, if somebody can answer that for me.
40 states have already adapted suitability requirements, and the NAIC had recently developed and enhanced those amendments to the 2006 suitability model in March of 2010. And so the insurance companies and what they're moving in is that the rest of the states by June 16, 2013 would have adopted the same rules and govern suitability requirements.
So if they adopt the suitability requirements, would that eliminate this problem that's been described about whether somebody would be disqualified from selling the product?
Is those one of the few is yes. That's why the suitability issues. 40 states have already accepted it, and then we want to make sure that all of the states are in conformity.
Okay, and what happens in those states that are not currently in conformity between now and June 16, 2013?
They would be continued, if the gentleman will yield, they would be continued to be regulated by the states, and the Rule 151A, the SEC rules, would not take effect. So the present regulation would remain.
So for that period of time, they're grandfathered? Is that
Well, it's a status quo. So yes, I guess you could say they. And if they fail by that date, then they would come under the regulation of the SEC if they didn't pass a model legislation.
Okay. I'm sufficiently confused, and I yield back.
In favor will say aye. Opposed, no. No. The ayes, a roll call is requested. On this, who votes? Just financial services. Although Mr. Boswell will be in our hearts as we do that. The clerk will call the roll.
Mr. Chairman?
No.
The chairman votes no. Mr. Kanjorski?
No by an instructed, yes by an instructed proxy.
Mr. Kanjorski votes aye by proxy. Ms. Waters? Ms. Waters? No. Ms. Waters votes no. Mrs. Maloney? No. Mrs. Maloney votes no. Mr. Gutierrez?
No by proxy.
Mr. Gutierrez votes no by proxy. Mr. Watt? Mr. Meeks? Mr. Meeks votes aye. Mr. Moore? Mr. Moore votes aye. Ms. Kilroy? Aye. Ms. Kilroy votes aye. Mr. Peters?
Aye.
Mr. Peters votes aye. Mr. Backus? Aye. Mr. Backus votes aye. Mr. Royce?
By proxy.
Mr. Royce votes aye by proxy. Mrs. Biggert? Aye. Mrs. Biggert votes aye. Mrs. Capito? Aye. Mrs. Capito votes aye. Mr. Henserling? Mr. Henserling votes aye. Mr. Garrett? Mr. Garrett votes aye.
Does the gentleman of North Carolina have...
I'm sorry, I couldn't hear you. Mr. Watt votes aye.
12 yeas and 4 nays.
Mr.
Clerk will report.
Mr. Chairman, on that vote, there are 12 ayes and 4 nays.
Well, the chair will announce that there were 11 and 4/5 ayes and 4 nays, and the House concurs in the Harkin amendment. I now recognize the gentleman from California.
Chairman, I have an amendment at the desk.
Designate the amendment.
Mr. Chairman, I ask unanimous consent that we dispense with the reading.
Yeah, let me just say, I ask you to understand, this was originally going to be done with a miscellaneous package. Some work was still being done, so it's under, but it's the only one left. So the gentleman is now recognized for 5 minutes.
Thank you, Mr. Chairman. Since I can take yes for an answer, I'll be short. Mr. Chairman, when I initially started down this list of amendments and you said let's work together en banc, and your staff went to work, like anyone else who's been on other conferences, I was less than optimistic that we would be here today with a 26-page, several hundred marked changed amendment in total that I believe is going to bring real transparency, something that I believe the outside conferees from government oversight wanted and had only hoped to get. So I want to be brief and simply say, Mr. Chairman, thank you. And thank the good work of your staff for working with all the outside agencies to get acceptable language in every single area so that we can begin having standards that are more interoperable and transparent. And with that, Mr. Chairman, I'm prepared to yield back.
I thank the gentleman. I think this has been very constructively worked on in a bipartisan way. I will confess that the negotiations were not done in public. They were private negotiations. Sometimes some people like private negotiations more than other times they like private negotiations. Whether or not they were in a back room, I don't know. They might have been in a front room or a side room. I didn't check.
Much of it in the hallway, Mr.
In the hallway, which I don't think is a back room unless you're not allowed in the hallway. But anyway, the kids in the hall having worked this out, I think we are now ready to adopt it. Gentleman from Alabama.
Yeah, Mr. Chairman, I think transparency through technology is a bipartisan issue, and it was the staffs of both the majority and minority staffs of both government oversight and financial services that work together, and that's where most of those negotiations occur.
The question now is on the amendment. All those in favor will say aye. Opposed, no. The ayes have it. I now offer the amendment that was left out today. It originally was proposed by the gentleman from Florida, Mr. Grayson, a member of the committee, although not of the conference, on the question of the timing of the release of information from the Fed audit. The clerk will designate the amendment. I apologize. This is to the House Title 11 offer. Let me hold off now before I do that. Are there any further amendments to the miscellaneous package? Yeah, you were done originally. So that would have been the miscellaneous. I just asked you a question. Are there any further amendments to the miscellaneous package other than this is not the miscellaneous package?
Not that I'm aware of.
Mr. Chairman.
Yes.
Will there be a provision dealing with student loans? Will that at what time will
can I finish this business?
Oh,
I now just let me. We'll deal with this amendment, then I'll put the question on the miscellaneous. So the question is now. I've now offered the Grayson amendment, which essentially says I recognize myself for 5 minutes. Then this goes back now to the Sanders amendment of the Senate. We'll be sending this to the Senate. Ms. Grayson was concerned that in the release of information about individual participants in that the amendment looking backwards, that the information as to individual participants might be unduly delayed because the facility might be unduly prolonged. So this says that the information will be made available, and there was back and forth on this, 2 years after the transaction. In other words, the concern is that 2 years after the transaction, the credit facility may still be going on, and therefore the information should be released. So that's the proposal. Is there further discussion? Gentleman from Alabama.
Chairman, let me just ask a hypothetical, well, actually a real example. In the case of AIG, this is the Treasury. In the case of AIG, where they paid certain counterparties, would this 2-year statute apply to them waiting 2 years before they reveal the...
No, let me say, first of all, this is not a restriction. This is a requirement. This is not restricting anything. This is requiring the release of information. This is in the Sanders Amendment, I think was just about the Fed, which requires the release of information that is not now required to be released. So this is not a retardation of the release of information. This is information that would otherwise not be released. And it's about the Fed, not the Treasury.
All right. Thank you.
Mr. Chairman.
Yes, gentleman, North Carolina.
Thank you, Mr. Chairman. The chairman knows that I have worked vigorously with Mr. Grayson and Mr. Paul throughout this process, trying to find common ground with them. I believe that this is an intrusion that would be inappropriate into the Fed making monetary policy and carrying it out. And I think this further amendment goes too far. So I will express my opposition to it and hope that my colleagues support me. But I've lost that fight several times. So.
Well, gentlemen, we are sending this to the Senate where this amendment originated. Those in favor of the amendment will say aye. Opposed, no. The ayes have the amendment is sent over. Next, we have, I'm now going to put the question on the miscellaneous package, which does not include this, but did include the ICE amendment. We adopted much of it before. I forgot to put the question. All in favor of that being adopted, say aye. Aye. Opposed, no. The ayes have it as adopted. We now have, I believe, the automobile dealer offer from the Senate. Is that correct? I guess we don't.
Mr. Chairman, we do not have the revised offer.
We will hold off. The Senate sent us an offer. We have proposed, there was a Republican amendment to simply, I guess, insist on the House position as is, and then there was going to be another amendment that would be a response that revises the Senate offer, accepts it in part, and rejects it in part. But we don't have it. It's at my request it was being redrafted, and I apologize. So that one is not before us. So we now have no further business until we get that, Mr. Chairman. The chairman of the Agriculture Committee, Mr. Peterson, is here, and he has a House counteroffer he's going to move on Title VIII. I now recognize Mr. Peterson.
Thank you, Mr. Chairman. We have a House counteroffer to the Senate counteroffer on Title VIII. I do not like Title VIII because, as I mentioned last week when we discussed the proper role of the Fed, I don't think the Federal Reserve has proven itself capable of properly regulating many of these entities, and I don't know why we would entrust them with additional responsibilities given that concern. Nevertheless, in an attempt to reach agreement on this title, the Commodity Futures Trading Commission and the Department of Treasury have worked on language that was offered last night by the Senate. While I disagree with the premise of the title, I appreciate the good faith effort and have considered the text carefully. This counteroffer that we're making makes further adjustments to that offer. It preserves the ability of the Financial Stability Oversight Council and the Federal Reserve to impose such risk management standards as they determine are necessary to address any insufficient prudential requirements. However, it returns the responsibility for carrying out those standards and exercising enforcement actions to the CFTC and to the SEC, recognizing that these entities have the expertise necessary. Additionally, the counteroffer requires a two-thirds affirmative vote for actions of the Council. If we're going to assign such heavy responsibility to the Council, we need to make sure that there's strong agreement on the decisions that they make. A final point, Title VIII initially had language that would require that any standards prescribed by the Federal Reserve will be more stringent, not less, and that would ensure that there's no backsliding in regulation. This language was struck in the Senate counteroffer. I think this is important to avoid weakening our system, and this House counteroffer reinserts that language. So, Mr. Chairman, I move the counteroffer to the Senate.
Has moved the House counteroffer to Title VIII. Is there further discussion on the counteroffer? Hearing no discussion, I now call for a vote on sending this offer on Title VIII to our Senate colleagues. Those in favor will say aye. Aye. Opposed, no. The ayes have it, and the offer is tendered. We are now waiting for the redraft of our response on autos. I believe that completes what we have for now, Senator.
Well, these lights. I thank you. We're about to propose. I'm waiting for the draft to come down on responding to Title II, but our colleague from Tennessee, who did a tremendous amount of work, along with, I mentioned several occasions, Mark Warner, for the Senate Banking Committee on this, literally weeks engaged with not only staff, but many outside experts as well in these areas of resolution. And so I want to give my colleague from Tennessee a chance to comment on all of this, since he was so deeply involved in the drafting of these proposals.
Thank you, Mr. Chairman. I very much appreciate the way that you put a lot of effort into getting a lot of bipartisan input, and I want to thank you here in front of everybody for that. I really want to speak more to the House conferees on this and say that I've watched the debate take place between resolution and bankruptcy and seen a lot of good points that have been made, candidly on both sides. And I think the whole notion of a resolution mechanism came out of the fact that when we had this crisis a couple of years ago, the regulators were left with a choice of TARP in their own minds, or because they didn't have a mechanism to unwind these organizations in an orderly way. And they felt that bankruptcy, as it was devised, did not work. So the thing I would say and I might wait till the chairman gets through doing what he's doing, whatever that is. That's a
Question?
I just want to make this one point about resolution. I've watched the debate, and I think it's been a good debate about resolution, and I know my colleagues from the Republican side have talked about bankruptcy. I don't think it's in anybody's interest on either side of the aisle or in either body to end up with a resolution mechanism that doesn't work. I think people are really trying to figure out a way to deal with a highly complex financial company. But I don't think we did the work we should have done. I know the chairman of the House Conference serves on the Judiciary Committee. One of the things that we never did as part of this whole legislation was cause the bankruptcy code itself to be adjusted to deal with a highly complex company. It just didn't happen. We tried to make that happen on our side. Candidly, there just wasn't any interest to have it taken up. I think the Republicans have made some very good arguments about bankruptcy. I know we on our side have done the same. That's not to say that in some rare instances a resolution mechanism, I may differ, may be necessary, but certainly it's going to be the only thing available unless we deal with bankruptcy in the appropriate way. And all I would say is, look, we haven't done that. A way to make us do that would be to sunset the resolution mechanism that we're putting in place in this bill, sunset it in 3 years. I know we didn't have the votes on this side, and on our side we tend to not prolong things that we know are not going to occur. But the fact is, I want to thank the chairman for allowing a bankruptcy study to take place. And it seems to me that I know there are numbers of issues that we have to deal with going down the road. We've got to deal with Fannie and Freddie because we're certainly not doing it in this bill. We've got other mortgage issues to deal with. I just hope for posterity purposes that we won't lose sight of the fact that there's a lot of work that ought to be done on bankruptcy to make it work for highly complex bank holding companies so we don't have to resort to a resolution in the first place. We haven't done that work. I hope we will. A way of making us do it would be to sunset this. There may not be the votes for that, but certainly there's still more work to be done, and I don't think it's a benefit for either side of the aisle to have something that could be abused. Let's face it, the Senate side did fix portions of creditors being dealt with in political ways, and I'm glad that we were able to do that. We do have some minor judicial checks, but this is an area I hope we'll all continue to work on and figure out a better way of resolving.
I would say two things, Senator, just to respond. I gather we're not debating any particular parliamentary thing. First, I understand your concern that the bill doesn't have enough things in it, because I do realize there are two very strong criticisms of this bill. One, that it's too big, and two, that it's too little. Because we are being told by some, not yourself, the bill's too big, but it would get bigger if we did some of those things. As to Fannie and Freddie, yes, of course we should deal with them. We took the lead in putting them in a conservatorship. I have not yet seen the plan that reorganizes housing finance and that assigns proper roles to a purely private sector operation, to the FHFA, to the Federal Home Loan Banks, to the FHA, to Ginnie Mae. I don't think there is any support for Fannie and Freddie re-emerging from the conservatorship, anything like the way they were before. I don't think we'll see a hybrid again. But I don't think, as does everybody in the housing field, they all agree we should not do away with them until we have put the replacements in. As to bankruptcy, we can continue to study it. But I do say what I said before. The notion that you don't go with bankruptcy with financial institutions, but you have well, let's be very clear. All of this comes from the constitutional power of bankruptcy. These are all forms of bankruptcy in the sense that the federal government would have no power to do any of this if it weren't for the bankruptcy powers in the Constitution. But whether or not there should be a special one for financial institutions, I'm struck, it seems to me, by an inconsistency that is perfectly comfortable with leaving the FDIC not following regular bankruptcy. And again, the FDIC has two roles. It pays off insured depositors. That's the mechanical part. But then it resolves institutions other than that, and not in the way of traditional bankruptcy. And what we're saying is that just as the FDIC in the non-deposit parts of financial institutions doesn't follow traditional bankruptcy, neither should the rest. But finally, as to being reminded of it, none of us are going away. The committee isn't going away, and we'll be here to talk about those things.
And again, we got a couple of things. We have a couple of minutes here. Say to my House colleagues before we can present something to you. But I want to we actually did get some cooperation, I would say. Senator Leahy's not here, but on a couple of critical issues, the Senate Judiciary Committee was very helpful to us in these areas by providing, without really any formal activity by the Judiciary Committee, a couple of steps in the process that we thought was important. And again, I think the FDIC, obviously the resolution mechanism, we've talked about that and how important that is. I've always said the three great contributions by our predecessors in the wake of, of course, the Great Depression of the early part of the 20th century were the FDIC, the Federal Deposit Insurance Corporation, which avoided bank runs. That was a magnificent contribution, so that flow that occurs, we know, on Friday afternoons when unfortunately a bank closes, and Monday morning when people can continue to do their business. So the fears that the country went through in the late 1920s, early 1930s, the FDIC was a great contribution. The Securities Exchange Commission was the second great contribution, in my view. People being defrauded, investing in creating wealth in our country and growing businesses and jobs. And I also think Glass-Steagall was a great contribution to our country and gave us roughly 60 years of economic stability in the nation. And so I have great appreciation for those. I think maybe the difference, and this is maybe just a question of where our emphasis is. Our emphasis is, while resolution, we want to make sure that can happen, that we also, when bankruptcy ought to occur in a company going and dying, ought to be able to happen too. And what happens is, in large interconnected companies, the bankruptcy code today would be very difficult to accommodate that. And so I think Senator Corker's notion, and I hope this would happen, I obviously won't be here for it, but others who will be, would take a look at how that institution could accommodate the highly interconnected industry going that route. How do we accommodate it? And that's we couldn't do it. I mean, we took on an awful lot in this bill. We didn't deal with everything. But the point of waiting until that could happen, not addressing financial reform, I think would have been a mistake. So that is a gap area, no question about it. We never claimed perfection in all of this. We got some good steps, we think, on that help out from the Judiciary Committee. But I agree with my colleague from Tennessee that this is an area that needs, at some point, to be addressed down the road. So I appreciate his comments on the subject matter.
Senator, procedurally, we have two items ready. We have a discussion has gone forward between the House and Senate majority staffs and others on fiduciary. I think we have an agreement there. We're about to send you something that I believe is agreed upon. I need to have it distributed, and then we're going to vote on your offer, a revised version of your offer.
Well, that'd be great. We're waiting. We should have in a few minutes to be able to respond to you on Title II.
All right. And then we'll be able to deal with the orders. I did just want to correct one thing when you said no one has claimed perfection.
Yes.
Actually, around March of last year, we were claiming perfection, but about 2 days later, we had to concede that was not there.
He was claiming perfection back when.
We just couldn't get unanimous consent on perfection. We will be in a brief recess.
Very brief recess.
Pending the distribution.
Just the way.
Advise members not to leave.
Contrary to popular opinion, we don't have something to say right now, so we're going to take a recess.
9, Section 913 has been distributed. So members of the House want to convene here. I'm going to move now submission to the Senate of our counteroffer for Title IX. This reflects much of the work that was done by the gentleman from Pennsylvania in his subcommittee. We had proposed a fiduciary requirement on people who are investment advisors. The Senate has said for study. What I believe has been agreed to is the following: a requirement that the SEC conduct a study with criteria that are to guide them in deciding the study and to report the findings within 6 months. It then gives them the authority subsequent to the study, conducted along the lines that the Congress will have instructed, to conduct a rulemaking and impose a fiduciary duty on those who provide investment advice. That's the compromise. So it does not immediately impose a duty. It requires a study, and it does not, as I said, mandate the duty, but it gives the SEC first the responsibility to conduct a study, the parameters of which are laid out in the bill, and reflect, we think, no bias one way or the other, and subsequent to the conclusion of the study, the ability then to impose a fiduciary requirement. Many of us believe that this is an easier question than others believe. I do not understand why people who are advising others shouldn't have a fiduciary duty. We're not talking about people dealing with their customers. We're not talking about counterparties. We're talking about individuals of varying degrees of sophistication receiving advice, and we think it ought to be conducted with a fiduciary duty. Is there further discussion on the offer? If not, the question is on the offer. All those in favor will say aye. Aye. Opposed, no, and the offer is tendered. Do we have the next thing ready? No, we're back in recess.
issue. Senator Johnson. Can we have some order, please?
The proposal from the House is accepted.
So we will, unless there's further debate on that, we would like to just ask all those in favor of the fiduciary duty provision as modified, say aye. Aye. Those opposed, no. The ayes appear to have it. The ayes have it. And we thank our colleagues in the House. I thank Senator Johnson, his staff, and others involved in that. That was a major issue for us, and I'm glad we were able to reach an accommodation on that. Okay.
We're going to convene. We're still distributing Title 10, but we have Title 9, Subtitle G, Corporate Governance, which is proxy access and Senate Majority Rule, and we are ready to deal with that. It's been distributed. It says House counteroffer, Senate Title 9, Subtitle G. I move that as the offer of the House. I ask the clerk to designate it. Well, no need. It's not an amendment. We'll just keep going. And then I recognize myself for 5 minutes. It's got two parts, one of which may be more controversial than the other. First, the Senate had in its draft a requirement about the election of directors by a majority vote in uncontested elections. The Senate has decided to strike that, and we concur in the strike. So that one will be out. Secondly, on proxy access, the Senate had sent us a version that said that you could only take advantage of this if you had owned not less than 5% of the shares for not less than 2 years. We disagree with that, and we submit instead instructions to the SEC which take the form of language. Remember, the SEC had begun this on its own. There were some questions about the authority. We appeared both to agree in our versions that the SEC should be given the authority, but the question is under what constraints. We believe, and we've heard very strenuous objections from the many of the pension funds, CalPERS that spoke to the gentlewoman from California and others, that there were real problems with this from their standpoint. A 5% holding and a 3-year holding seemed to us to be, or a 2-year holding, particularly the percentage. I am much more sympathetic to the holding period than when you start getting up in the percentages. We instead want to send the SEC instructions that say they shall issue rules permitting the use of proxy materials. Remember, this is the ability to use the proxy materials, just to neutralize the advantage that the incumbent boards of directors have. It doesn't change anything about the number of votes. It just says you get a kind of fair access if you want to debate this and dispute it. It could be limited to shareholders who have a long-term interest in the prosperity of the issuer, so that the SEC would be told to increase that. And they shall consider, as they determine that these are people with a long-term interest, the number of shares they hold, the length of time they've held the shares, whether or not it should be tiered into the size of issuers. The question also is they can consider whether to require any shareholder to hold shares for a period of time after being elected. And it says, for the purpose of the rules required in this section, a shareholder who has held shares for less than a year shall not be permitted to use proxy solicitation. So we give the SEC instructions to take into account long-term interest, but do not believe it is wise for us to start picking specific numbers and specific percentages. Is there further discussion on the offer? If not, the gentleman from West Virginia.
Chairman, I have a parliamentary inquiry on Title 10, please, because I have an.
Well, we're in Title 9 now.
Oh, I'm sorry. Well,
I'll
wait.
We'll get to Title. But to answer the parliamentary inquiry to the title we can get to, the parliamentarians now rule that we will vote on both amendments no matter what happens to the first one. The First Amendment will be a perfecting amendment. This is on the auto dealers. And that whether that wins or loses, it's a perfecting amendment to the base text. The gentlewoman's amendment would still be in order. The question now is on the House offer. All in favor say aye.
Aye.
Opposed, no. The ayes have it, and the offer is made. Has Title 10 been distributed yet? Has Title 10 been distributed yet?
Yes, Mr. Chairman.
Title 10 has been distributed. So I now move Title 10 for the House response on Title 10. And can I have the paper that describes that? Which are the talking points of the auto dealers? List of what the changes are. Let me begin with the auto dealer issue, which has been somewhat debated. The House had an exemption from auto dealers from the Consumer Bureau. We then had a different version of that offered by the gentleman from Illinois. I voted with him. We lost. That would have said that if the FTC hadn't done the job right, it would go to the Consumer Bureau. The Senate sent us an offer which said that the FTC would get enhanced powers here of the kind that the Energy and Commerce Committee on our side has been pushing for in general to deal with this. It also had some other references to the Consumer Bureau. It would otherwise leave the law as it now is. The Federal Reserve has certain laws and it would continue to have them. In our counteroffer, we have stricken all references to the Consumer Bureau. That is, I think it is time for people like myself who disagree to concede that the votes are not there to give the Consumer Protection Bureau any role in this. But we do believe that it is reasonable now that it will stay with the FTC, and we are not increasing the authority that the FTC has. There is no further grant of powers other than what the FTC already has. We are simply trying to expedite the procedures of the FTC here. It will be auto dealers still a separate entity. They'll have a separate regime. They won't be under the Consumer Bureau. They will continue to be under the FTC. The Federal Reserve will continue with regard to them to have the jurisdiction it now has over truth in lending, but it will expedite the ability of the FTC to act, responding to the concern we've heard from the Pentagon and others that this is an issue that ought to be addressed. It also makes it clear, by the way, and we didn't want to have any misinterpretations. Some had interpreted the language of the auto dealers to say that if you were an auto dealer, the exemption was not for the practice of selling cars, but a personal exemption, so that if you decided to become a loan shark on the side, you were immunized. I don't think there's any controversy about making clear that the exemption, and I think this is generally what we try to do in the Consumer Bureau, or to the extent that we exempt or cover, we are exempting or covering activities, not persons. And the fact that you are exempt in one area doesn't mean that if you decide to do them elsewhere, you're not. But the key issue here will be on the FTC. Now let me ask on the other changes that we make. Do we say yes or no? What do we do? All right. With regard to the Snow Amendment on regulatory flexibility, we believe that is, at this point, an undue burden on the consumer agency, and we propose to not abolish it, as some would like to do, but to try to make it less of, we think, a hindrance to good enforcement. With regard to payday lenders and people who check cashers, this is a very important one to us. The way the Senate version is, in our version, the Consumer Bureau had jurisdiction over all of them because they are, we think, many cases not enforced and not regulated at all, or very poorly by some, in some cases. What we propose, the Senate bill does acknowledge that rulemaking by the CFPB should cover them, but it does not allow CFPB, Consumer Bureau enforcement for complaints about payday lenders, check cashers, or remittances. It also does not allow the Consumer Bureau to be the examiner of them. We concede on the examination part, but we do believe that there ought to be an authority to hear complaints. If they can make the rules and there is a complaint, we think they should be able to do it. We make a similar view with regard to banks under $10 billion. We initiated in our bill exempting them from the examination, but we do think that a complaint against a bank of the violation of a rule ought to be heard in that Consumer Bureau, which will have, I will tell you, it is very clear to me, having dealt with this, that the existing bank regulators have virtually no effective mechanism for resolving individual complaints. It's not what they do, it's not what they care about, and the Consumer Bureau is the appropriate place to bring single complaints. Examination, which can be burdensome, would remain with the prudential regulators, so we would not change that. Finally, a very important issue to the gentleman from California, Mr. Waxman, on behalf of his committee, to give the FTC the kind of streamlined authority, being able to move, that we have given to the Consumer Bureau. So I now move those 5 offers. Is there discussion or amendment? I have an amendment by the gentleman from Alabama.
Thank you. Thank you, Mr. Chairman. As I said yesterday, Congress obviously had grave concerns about the FTC's use of its original rulemaking authority, and so much so that in 1975, they passed Magnuson-Moss procedures to ensure commission rules are thoroughly considered and vetted, given the broad range of the economy under the commission's authority. And as I understand the issue now, it's whether or not the Magnuson-Moss provisions will apply to automobile dealers.
I didn't know that.
They are Magnuson-Moss procedures are rigorous, but in my opinion,
what an honor.
They should not be removed. And I'm mumbling. Okay, sorry. So I don't support this amendment. Let me just say that.
Debate.
Mr. Chairman.
I have a suggestion. The parliamentarian has asked, I think the one where we're going to get the most, I think, debate and perhaps some uncertainty of the outcome is over the auto dealers. So I would then, with the consent of the body, let's debate everything else, and then we'll do the auto dealers when we've done the other 4 points. So we're now on the regulatory flexibility, enforcement for payday lenders, remittances and check cashers, and rules about small banks, and the FTC streamlined authority. Is there a debate on the Democratic side? Let me just say we've asked for Mr. Waxman to come. In fairness to him, we just brought this up. Gentleman from California.
Thank you very much, Mr. Chairman. I want to take some time to clearly understand what we're doing with the payday lenders. This has been a real source of pain for many communities across this country, including our military bases, where we have had payday lenders set up operations and hooked many of our military families on loans with 400% interest, and in some cases more. So when we talk about we're exempting them from examination, but they will have the ability to hear complaints, I need to understand what we're talking about and what the authority is to deal with these complaints. One of the things I do not want us to do is to lose the opportunity to do something about a problem that has been persisting in many communities across this country for far too long. As we wrestle with this reform that we have embarked upon, this is one of those areas where we must demonstrate to the people of this country that we are serious about dealing with the kind of exploitation that has been perpetrated on far too many people for far too long. So if I may engage you, Mr. Chairman, on this discussion of exempt versus complaints, would you please explain, if you would, to me exactly what we're exempting them from and what authority will they have on complaints? I'll yield to the
Senate bill that exempts them. We are trying not to exempt them. The House version, there are 3 aspects of the Consumer Bureau. It makes rules. It is the arbiter of complaints about the specific rules, and there is the examination process. What we did in our bill was to say that with regard to the examination process, which can be burdensome for banks under $10 billion and credit unions, the examinators are the prudential regulator, and the Consumer Bureau could join in. But with regard to enforcement and rulemaking, we said these entities were covered. The Senate bill agrees that rulemaking power will reside in the Bureau over all of these activities, check cashing, payday lenders. But the Senate bill says that complaints against them for violating the rules will not go to the Consumer Bureau, but will go to their existing regulators, which we, on our side, had found inadequate. So what this does is reverse the Senate exemption from case-by-case enforcement in this particular set of instances for payday lenders. It would not give them examination power. I'd like to have that, but it would at least give them the power to do that. So the gentleman's question, this amendment doesn't exempt anybody from anything. It rolls back an exemption they have in the Senate bill. Is there further discussion? Gentleman from Texas.
Thank you, Mr. Chairman. I just want to make a couple of brief comments on two sections of Title 10. One, following up on the gentlelady from California. Again, when we're talking about payday lenders, in all of the hearings I've been to, in all of the materials I've studied, I've yet to find one individual who has made any connection whatsoever between the financial crisis of 2 years ago and payday lenders. I just state that again for those who say we are passing a bill that has to do with the future financial stability of the nation, that is dealing with a crisis. Again, what are payday lenders doing in here?
Yield?
I'll yield to the chairman.
I don't know who set the rule that we can only deal with reforms, as many of us believe them, that dealt with the past crisis. No, I've never said that, and anyone who said that, I would join the gentleman in saying you're wrong. We never said that we were limiting this bill simply to problems that were, because I hope the Consumer Bureau, for instance, will deal with overdrafts and credit card abuses, and I don't think they caused the crisis.
Well, I thank the gentleman for his comments, and I understand that we're operating under the chairman's rules, and so clearly we have a rule where we can deal with payday lenders. We just can't reform the government-sponsored
Would the gentleman yield?
Be happy to yield.
No, that's an absolutely unjustified assertion. Payday lenders are in the original bill. So what guides us is what's in the original bill. The difference between GSEs and payday lenders is that payday lenders were in the House bill.
Okay,
in the Senate bill, so that's a very different situation. Gentleman wants to make arguments on the merits.
I'm reclaiming my time, Mr. Chairman, knowing that you will have plenty of time. I understand the chairman's point. But as a substantive matter, we'll put procedure away. As a substantive matter, we are not allowed to offer in this piece of legislation amendments that deal with the reform of the government-sponsored enterprises where there is a whole host of testimony and academic studies and observation by many that they were at the absolute crux of the financial crisis. I simply find it ironic. So even if I concede the chairman's point on the process, although I still find it somewhat ironic that an amendment on the Stone Ridge case is germane, amendments on the government-sponsored enterprises aren't, I'm just pointing out for those who are saying, and perhaps it's not the chairman, perhaps it's others, who have said, again, we are coming up with a piece of legislation. I'm not quoting the chairman, but there are many proponents who say we have to have a piece of legislation to deal with the crisis. My only point is there is so much in this bill that doesn't deal with the crisis. I think it's something important for the American people to know. And with respect to payday lenders, I lament those who necessarily find themselves in any kind of condition where they have to borrow money when they may not want to, but I would point out for many struggling families, it is preferential to go to a payday lender than to pay a bounce check fee, to pay a utility reconnect fee, to get an eviction notice. So I would like that to be noted. Finally, I want to also point out another aspect, another provision of Title 10, which I don't believe had absolutely anything to do with the financial crisis, and I know it's in both offers, has to do with interchange. And I just ask the question respectfully, what does that do? Regardless of how you feel about the issue one way or the other, what we know is it's a fee between a merchant bank and a cardholder's bank, in this respect to a debit card. I'm just curious, again, what is it doing in this bill? And for those who believe this is about Al's Hardware versus Citibank, it very well may be Walmart versus Citizens Bank of Anytown, USA. and more likely it is a struggle between Citibank and Shell Oil. And I'm just curious, again, why would we want to be picking winners and losers in that particular fight? And for those who believe it pro-consumer measure, I would point to the experience in Australia, where after similar legislation was passed, you had higher fees, lost rewards, and no evidence that consumers benefited in any way. With that, Mr. Chairman, I yield back.
Gentleman, Pennsylvania.
Seek recognition, Mr. Chairman.
Gentleman is recognized.
I yield 5 minutes, Chairman.
Well, I have to say, my friend from Texas now, I guess once you have 5 minutes, anything is permitted, including sort of random association. There's nothing in here in this offer about the interchange fees. It wasn't in the House bill. It was in the Senate bill. A motion not to accept it would have been in order. It didn't come. When we dealt with that part of the title that had it, the gentleman never made such an offer. So maybe you want to just save it so we could complain about it and not make people have to vote on it. As to the notion that this bill shouldn't do anything unless it could clearly or in some way have been shown to cause a crisis, I reject that. I am very proud of a Consumer Protection Bureau. I understand the gentleman from Texas
Would the gentleman yield?
Yes.
Well, is the chairman complaining that he doesn't have the power to admit something from the conference report?
I don't understand that question at all. Am I complaining that I don't have what?
Do you have
repeat the
you
question?
were off. You were, if the gentleman would continue to yield, asking about opportunities to offer a previous amendment. I'm just asking if the chairman felt that he agreed with the point. Doesn't he have the power to admit it now?
No.
I'm not.
I would say this to the gentleman. First of all, I'm one member of the conference committee. There are things in here that I disagree with. I work hard. I hope I have more influence than some others because of that and because I'm the chairman. But no, I do not have the power to omit anything. If I had the power to omit, this would be a smaller bill and probably a smaller room. The fact is that I am one of many conferees. The point I was making is the gentleman is now, after it is safe to complain about the interchange fee, complaining, but the time to have made an amendment, which you want to do, is passed. As to me, I didn't want to put it in the bill. I didn't think it was directly relevant. But when 64 senators vote to put it in and we're in a bicameral process, that's the reality. And one can complain about the reality, as the gentleman did, but again, safely after he could not have had to make a motion on it. Secondly, we're not banning payday lenders. We are regulating them, as many of us believe other people should be regulated. And I agree that it might be preferable to overdraft fee. That's why we are giving the Consumer Bureau the ability to regulate overdraft fees, even though it didn't contribute to the crisis. But I think it's something that people ought to have. But now I want to just go back on Fannie Mae and Freddie Mac, and he says we're not doing anything. I am struck by the gentleman from Alabama who has apparently, he does not hear it when his colleagues bring it up, but only does when I bring it up. I'm going to ask him to face the other way, so maybe then he'll hear it on both sides. I'm responding to the gentleman. No, all the way around, all the way around, all the way. So you can hear when they say it. The fact is that the gentleman from Texas just brought up Fannie Mae and Freddie Mac again, and of course, we're supposed to listen to distorted versions of history and not respond. I mean, I was interested in the gentleman from Texas's quote in the Wall Street Journal from 2005, which they mentioned today, in which he praised subprime loans, said that you couldn't have only people who were wealthy get loans. At the time that he was praising subprime loans, many of us, led by the gentleman from North Carolina, were trying to ban abusive subprime loans. Beyond that, as to Fannie Mae and Freddie Mac, I wish this zeal for reforming Fannie Mae and Freddie Mac had manifested itself effectively during the 12 years of Republican rule when, with Republicans, many of whom were at this table, were in power, they couldn't do it. And the gentleman from California, Mr. Royce, tried. But he was in a small minority among his fellow Republicans. And it wasn't until 2007, when the Democrats took control, that we adopted it. Yes, there are losses. There are losses that occurred because the Republicans weren't able to do in 2005 what we did in 2008, because all those time had gone by. Those are the facts, and we have to deal with those facts. But now, if I may be permitted to get back to the subject matter of the amendment, the question is what we have offered. I do think that the gentleman from California, who will be here soon, has made a very important point about the FTC having better power to protect consumers. And I also believe that not having any effective place to bring complaints against abusive payday lenders, abusive check cashers, or people who are abusing in the remittance area is a great mistake. And that's the issue. Not abolishing them, not saying that they are terrible, only saying that if you have a rulemaking capacity, having no one to enforce the rules that you make is a very serious error. And is there further discussion? I recognize the gentleman in California. Let me give the gentleman a time let me just, for the gentleman from California, I apologize to him. I try to give him more notice, and members have a number of conflicting duties. We are now in our counteroffer to the Senate, in which we renew our request, which members of our committee on the Democratic side strongly support you in, for the FTC streamlined authority. The gentleman from California, the chairman of the Energy and Commerce Committee, is recognized for 5 minutes.
Thank you very much. This new agency that we are creating is going to operate under the Administrative Procedures Act. The same rules that guide the Securities Exchange Commission, the Commodities Futures Agency, most government regulatory agencies operate under those rules. The Federal Trade Commission, however, because of an anomaly, operates under two different procedures. And for a lot of what they're doing, they operate under the Administrative Procedures Act, but for their basic core functions of protecting against fraudulent and deceptive practices, they're required to use a different procedure. And that's known as the Magnuson-Moss rules that can take them up to 8 years before they can finally act. It doesn't make sense. So what we have proposed in the House and passed is that the FTC would operate under the same rules as the new consumer agency and these other agencies. They would operate under the Administrative Procedures Act. And it also pertains to some enforcement authorities that the other agencies have, and we would extend to the Federal Trade Commission as well. So, Mr. Chairman and Mr. Chairman, that has been the position of the House, and I would urge it to be adopted by the conference.
Is there further debate? If not, the question on all parts of the offer except the automobile dealer will be voted on now. We'll divide that because then the gentleman from West Virginia has a separate amendment on that. So the question is on accepting the counteroffer with all of it except reference to the automobile dealers. Those in favor will say aye. Aye. Opposed, no. The ayes have it, and it is so ordered. Now, we have before us the FTC piece. Let me explain the parliamentary situation, because I'm about to recognize, actually, the gentleman from West Virginia. I had explained something to her, and I had misunderstood the parliamentary situation. In the counter-offer, the Senate sent back an amendment to us, just want to set the stage here, which gave expedited authority to the FTC with regard to autos, but also had various fallback positions that would go to the Consumer Bureau if those weren't well exercised, and made some other affirmations. Our counteroffer strikes that latter part. We, as I said, concede that there is no, and this is really just by way of explanation, not argument at this point. We concede on our side, those of us who had a different position, that there'll be no consumer role for autos. I wish there were, but I've lost twice on that, and I don't see any way to, there's no point in prolonging it. I do think that the part about enhanced FTC authority makes some sense. And it also, we just affirm that nothing else has changed with regard to auto dealers. The gentleman from West Virginia has an alternative approach. So I'm going to recognize her, and then I will respond to her, and we will get this done. So the gentleman from West Virginia is now recognized to offer an amendment to the counteroffer of dealing with automobiles. The clerk will designate the amendment.
Amendment to the House counteroffer.
I ask unanimous consent the amendment be considered as read, and the gentleman from West Virginia is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you for working with me on this issue. My amendment simply goes back to what I think is the will of this Congress on both sides, and that is the original House offer that exempts car dealers from not just the CFTB, but also from the expanded powers that are enumerated in the House offer under the FTC. What I'm really looking for here, that if we think about car dealers, we know that's Main Street, that's employers, that's Little League sponsorships, that's really the heart and soul of places where I live in West Virginia and certainly across this country. And these are the jobs. They have got like a 40% downturn in their business right now, and to give them uncertainty in how to conduct their business and to try to help, as they help everyday people with the financing of the second biggest purchase in their life if they don't have a home, I think is very important. So what I'm trying to seek in this amendment is the certainty that we had under the House language that was passed in the House Financial Services Committee by 47 to 21. And then the Senate, under Senator Brownback, offered a motion to instruct with the same language that passed the Senate 60-30. I do acknowledge that in the offer that you're going to put forward, you've moved quite a bit from the Senate offer, and I'm very pleased about that. So basically what I'm asking is for us to go back to the original will in both houses, to seek the clarity for this economic engine that's in our communities, that being car dealers and small business people, and to give them the clarity that they need to move forward to know how to conduct business, how to do it within the boundaries of the law, how to do it treating all of those fairly. And so that's the essence of my amendment, and I would urge encouragement of, and basically, I'll restate it, it's moving back to the original language. I would like to repeat as well, we did have the vote in the conference committee, as you recall, and the House language prevailed in that.
Let me just say I'm going to recognize the gentleman from Kansas, but I thank the gentleman for working with us as we dealt with this situation. The gentleman from Kansas is now recognized.
Thank you, Mr. Chairman. After review, I oppose this amendment. The language proposed by the House in their counteroffer regarding the auto dealer exemption is much more modest than an earlier amendment which I voted against. First, it doesn't give rule writing authority to the Consumer Bureau. Additionally, there will be no primary or backup authority given to the Consumer Bureau to enforce rules pertaining to auto dealers. The FTC would retain its sole enforcement power. From my perspective, this will put the auto dealers at the same level as community banks under $10 billion I worked to exempt from CFPA's regular enforcement authority. I don't see the need to treat auto dealers or community banks differently, and this will ensure the new Consumer Bureau is fully focused on the true problems at big banks and mortgage brokers, some of whom were at the center of the financial crisis. I ask my colleagues to oppose this amendment. I yield back my time, Mr. Chairman.
From Alabama.
Thank you, Mr. Chairman. Mr. Chairman, correct me if I'm wrong, but this is called Wall Street Reform Bill.
The gentleman yield?
Yes.
Well, it's actually called, because I think we took the Senate title, the Restoring American Financial Stability Conference Amendment, or the RAFSCA.
All right, Restoring Financial Stability.
American Financial Stability.
All right, Restoring.
Germans are on their own.
I'll take that. I'll either take Wall Street Reform, which was a House bill, or Restoring Financial Stability. Now, ask yourself, what did the automobile dealers have to do with that? Did they cause the financial instability? No. Are they a part of Wall Street? No. Did they suffer? Yes, very much so. In fact, I don't know of any industry that has taken a bigger hit from the constriction of credit than the auto industry. So I accept the wisdom of 60 members of the Senate, 60 or 62, which voted to exempt them from this Wall Street bill, or if you want to call it financial instability bill. The only connection they have with the financial instability bill is many of them fail because of that instability. And in the House, the vast majority of the House voted to exempt them from the bill, as I recall.
The gentleman would yield. We actually never brought it to the floor of the House. We lost in committee, and
in committee it passed.
It passed in committee
to exempt them.
The majority of the members of the House did not vote on it, and some of them are still grateful to me for that.
Well, both the position of the House and the Senate was to exempt the automobile dealers, and I really think we're tightening the screws on an industry that has had a desperate 2 or 3 years. And when you do that, you're going to tighten credit of people who want to buy automobiles. And I would say this: we'll vote on this. Obviously, you've switched some votes. But I'll say this to my Senate colleagues. The House counteroffer that you're going to get relating to the FTC is essentially the same language as the House's original offer. Now, you rejected that. And I would urge my Senate colleagues to, again, reject those provisions because, Senator Dodd, you said yesterday there's been no foundation laid for this on the Senate side. Now, if we want to introduce legislation and let it go through the House and the Senate, it goes through the Energy and Commerce Committee, it goes through the Financial Services Committee, and this body decides for the first time, the majority of the members on both sides that we are going to subject the automobile dealers to tighter restrictions, then that would be the will of the House and the Senate. But I believe there's a reason why we normally have regular order, and one of the reasons we have it is to avoid the outcome that we're going to have at the end of the day as far as the automobile dealers. I yield back the balance.
Well, I recognize myself to say very quickly. I just would say this. The gentleman's preference for the regular order and his respect for the wisdom of 60 senators seems to me to be an interruptible flow. I would not, if I were one of those senators, take the gentleman's endorsement as a long-time one, nor would I say as chairman that I regard his insistence on what he calls regular order as immutable. The question is now on the amendment. The gentleman from New Jersey.
Thank you. Let me begin by commending the gentlelady for her amendment. It is appropriate and fitting that the amendment brings up. And when I think back to, our opening day, and I didn't make the note of the speaker, but I think it was the gentleman from North Carolina. And I've looked back at my notes as the statement said, it is not a reason for something not to be in the bill just because it was not a cause of the financial crisis. That certainly does apply in this situation, that they put in regulation for the automobile industry, and no one from any expert that we heard from, no one from any committee hearing that we ever had, no one from inside this room or outside the room have ever alleged that the underlying cause of the financial crisis we're in today is because of the auto dealers. And when you think about it, quite the...
The gentleman yield?
Yeah, sure.
You seem to be quoting the gentleman. You're talking about this gentleman from
I think so.
Okay.
It was one of your opening statements. Yeah.
All right. Well, let me just be clear. There are a bunch of things in this bill that cover things that nobody has alleged were caused.
Reclaiming my time, that's exactly the point that you were making, that there's a lot of stuff in this bill that has absolutely nothing to do with the crisis, and that was the statement that the gentleman was making, and I was just reminding the committee that the gentleman made that statement, and this is another example of one of the things that is in this bill that was not a cause of the crisis, but even in this situation, maybe it's even worse, because a lot of industries and a lot of people were hurt because of this crisis. But when we consider the impact upon the automobile industry because of this financial crisis, they're in some of the top tier groups of people in industry that were hurt. Now, I don't see Mr. Cummings sitting over there today. I guess it was just yesterday that he was speaking quite eloquently and passionately about the constituents in his district who are suffering in the past and now because of this financial crisis. And I'm sure if he was here, he would share with me that he has heard from, just as I have, from automobile dealerships, family-run businesses who have suffered more than many other people in their communities and lost their...
Gentlemen, continue. We're getting a little bit of background noise.
Sure. I appreciate that, Chairman. Who have lost their businesses, who have been in the families for generations because of this crisis. And now what do? Are we rewarding them for their toughness and sticking to it and trying to claw their way out of this crisis? No, we are rewarding them with even more penalties, more punitive legislation, more punitive regulations in all the areas that the gentlelady has already outlined, tougher regulations and restrictions that do nothing to address the problems that we may see in the future on this. Now, I believe it was the chairman and someone else that says, well, it'll allow for the enhanced rulemaking authority, and maybe it wasn't the chairman who said it, so I don't want to cite him. We already have the systems in place for the due diligent and thorough and thoughtful process as far as the regulations for this industry that is in place now is necessary. And I believe the gentleman from Texas reiterated a number of those points as far as the regulations, as far as consumer protection and the like, just the other day. They're already there. The federal regulators and the Fed and otherwise already have the authority in place necessary to protect the consumers. So this is not about trying to do something that's not being taken care of now. This is about making sure that the auto dealers are family-run, small businesses who will be able to sustain themselves and grow out of this tough economic crisis. And I think we should do everything we can to stand beside them. And I appreciate the gentleladies for championing that cause. Thank you. I yield back.
Mr. Chairman.
Gentleman from North Carolina.
I really wasn't planning to get involved in this debate, but since the gentleman has taken only part of my statement, I want to just be clear that the chairman and I, from day one, have taken the position that the financial transactions of automobile dealers ought to be included under the jurisdiction of the agency or bureau of whatever agency we end up with. I agree with the chairman that we have lost that vote twice now, and that jurisdiction should go under the majority will of the House, clearly, and under the instructions that were given to the senators to the FTC. But to put it in the FTC in a process that would take them 8 years to react to some kind of emergency situation seems to me to be just absolutely foolhardy. So where we have gotten to is a significant compromise. I don't like it. I'd rather put these financial transactions under the Consumer Financial Protection Bureau. That's been my position from day one. It continues to be my position, notwithstanding the fact that even somebody has filed some charge saying that I've changed my position. I have not changed my position on that and do not intend to change my position on that.
Well, the gentleman...
But no. Let me just finish my statement.
I yield it to you, but okay.
I'm going to yield to you, but I want to finish my statement before I do that. To say that we're going to give this jurisdiction to the FTC and then say that they'll do it under their existing rules when this could create very bad consequences in our congressional districts if it's not monitored and dealt with on a regular basis, and then tell the FTC that you've got to go through a rulemaking process that could take up to 8 years before you can do something to respond to to some predatory practice or some kind of thing that is contrary to the consumer's interest. Now, I don't presume that that's going to happen. It is true that I represented, when I was practicing law, a number of automobile dealers. I think most of them are reputable. But the ones who are not reputable and the ones who are engaging in unsavory practices to the disadvantage of consumers ought to have a process in place where it can be addressed immediately, and that is the compromise that we are advocating for. And it's an acceptable compromise to me, but I don't want the gentleman to think that I've given up on my original position. I have not. We just can't get there. We don't have the votes to get there. But that's not a reason not to give this enhanced rulemaking authority to the FTC so that we don't allow some abuse to continue to take place for 8 years. That is what we are trying to avoid happening in the future. Just because it didn't happen in the past doesn't mean we ought not have a prophylactic process in place or something in place to respond to it if it happens in the future, and that's all we're trying to do. I yield to the gentleman if he wants to respond.
Well, sure, in the 30 seconds left. First of all, the FTC already has the authority, and you're suggesting that they do, but it's a long period.
That's exactly right. And if you understand the process, you'll understand that that's exactly the case.
Well, then I guess since you have represented auto dealers and you know your district well, can you cite, for example, specific examples, because we have not heard them during the committee process, where they were not enforced, both the federal law
I have
or
not
the state
said
level?
that historically they were the problem. I'm saying if they are the problem in the future, there are a lot of things under the Consumer Financial Protection Agency or Bureau that were not problems in the past that we're putting there.
The time for gentlemen's time has expired. The question is now on the amendment because we have a vote pending. All those in favor of the amendment to the House offer will say aye. Aye. Opposed, no.
No.
The noes have it. The amendment is defeated. The gentleman asks for a recorded vote. The Energy and Commerce and Financial Service Committees can vote on this. The clerk will call the roll, and then we'll go vote.
Mr. Chairman?
No.
The chairman votes no. Mr. Kandrowski?
No.
Mr. Kandrowski votes no. Ms. Waters?
No.
Ms. Waters votes no. Mrs. Maloney? Mrs. Maloney votes no. Mr. Gutierrez? Mr. Gutierrez votes no. Mr. Watt?
No.
Mr. Watt votes no. Mr. Meeks?
No.
Mr. Meeks votes no. Mr. Moore?
No.
Mr. Moore votes no. Ms. Kilroy?
Aye.
Ms. Kilroy votes aye. Mr. Peters?
Aye.
Mr. Peters votes aye. Mr. Waxman? No. Mr. Waxman votes no. Mr. Rush?
No by proxy.
Mr. Rush votes no by proxy. Mr. Backus?
Aye.
Mr. Backus votes aye. Mr. Royce?
Aye.
Mr. Royce votes aye. Mrs. Biggert? Mrs. Biggert votes aye. Mrs. Capito? Mrs. Capito votes aye. Mr. Henserling? Mr. Henserling votes aye. Mr. Garrett?
Aye.
Mr. Garrett votes aye. Mr. Barton?
Aye by proxy.
Mr. Barton votes aye by proxy. Mr. Chairman, on that vote, there are 9 ayes and 10 nays.
The amendment is, question now comes on sending the rest of the Title 10 offer to the Senate. Those in favor will say aye. Title 10, is it Title 10, am I right? Yes, Title 10. Those in favor will say aye. Opposed, no. The ayes have it. The offer is submitted, and we will recess to vote. The Senate will be back soon, and we will be back as soon as our votes are through. And we have, I think we will be able to do a little bit more business, and then we will have the Mercury Levin Amendment, and then we will deal with derivatives. So the cartoons are over. We're about to get into the double feature.